Welcome back to the deep dive. Today, we are talking about a divorce.
Hmm.
And before you reach for the tissues or, start taking sides, we aren't talking about a celebrity breakup.
No, and definitely not about who gets the beach house, though the stakes are probably higher.
Just a little bit. We are talking about the contested divorce between the United States and China.
Right.
And if you think you've heard the story before, trade wars, tariffs, all that, you might want to lean in because the data we are looking at today paints a picture of something much faster and much deeper than just a diplomatic spat.
It really is. It's a fundamental rewiring of things. We're digging into a cult article titled, U.S. and China Accelerate Contested Divorce in Critical Sectors.
And it pulls together data from some heavy hitters.
Oh, yeah, the Wall Street Journal, the National Bureau of Economic Research, Project 44, the real data people.
So the mission for today is simple. We want to look past the political rhetoric, past the speeches, and get into the hard numbers. We want to understand the actual business moves that are defining this split as we sit here in early 2026.
Right.
Because honestly, looking at these sources, I was just shocked by the sheer speed of it.
It's the velocity that stands out. Absolutely.
Exactly. I mean, we've gone from integration to uncoupling so fast it'll make your head spin.
Well, let's unpack why that is, because for a long time, the narrative was interdependence.
Right, chimeric.
Exactly, Chimerica. The idea was that these two economies were so tangled up that they couldn't possibly split without, collapsing.
Yeah.
But what we're seeing in the data from 2025 and now into 2026 is that both sides have decided the cost of staying together is higher than the cost of splitting up.
Okay, let's get right into the scale of the split because there is one number in this research that it stopped me in my tracks.
I know exactly the one you're talking about.
7.1%.
That is the big one. That is the headline number.
As of May 2025, China's share of U.S. imports fell to a low of 7.1%. Now, to the uninitiated, numbers can feel a little abstract. Is that low? Is it high?
It is historic. To give you some context, 7.1% is the lowest level recorded since 2001.
2001. Wait, that's almost 25 years ago.
Right. And significantly, that's the year China joined the World Trade Organization.
Wow.
So if you think about it in terms of trade volume, we have essentially erased nearly 25 years of economic integration. We are right back where we started.
That is wild. We've rewound the clock a quarter of a century, and it happened so quickly.
It did. If you just look back at 2017, which feels like yesterday in geopolitical terms, China's share was at 21%.
1/5 of everything.
Think about that dominance.
Yeah.
1/5 of everything coming into the U.S. was from China. By mid-2025, it had already plunged to about 9%, and then it hit that 7.1% floor.
That is a free fall.
It's a collapse. There's no other word for it.
But let me ask you this, because usually when we hear about this, it's framed as the U.S. shutting the door. Is this just American protectionism, or is this a two-way street?
Oh, the divorce papers are signed by both parties. This is definitely mutual.
Okay.
The data from Project 44, and they track global supply chains, so they see the containers moving.
They see the reality.
Exactly. It shows that U.S. imports from China fell 28% year-on-year by 2025. But here's the kicker. U.S. exports to China plummeted even harder.
How much harder?
Down 38%.
Wow. So American companies are selling significantly less into the Chinese market as well.
Correct. It's one of the steepest bilateral trade contractions we have seen in recent history.
Yeah.
We aren't just seeing a slowdown, we are seeing a reversal. The trade lanes are literally drying up.
So if they aren't trading with each other, what are they doing? Because you don't just cut off your biggest partner and sit on your hands. That's economic suicide.
No, you prepare for life alone. Or, more accurately, you prepare for a siege. And that's where China's strategy gets really fascinating. The scale of it is just staggering. They are building a fortress.
A literal fortress.
An economic one. The source material highlights that since the beginning of 2024, China has committed roughly $1 trillion to achieve economic self-sufficiency.
1 trillion. With a T.
With a T. And that is a massive amount of capital to deploy in such a short window. And when you follow the money, you see exactly what they're afraid of.
Okay, so if I'm building a fortress, where do I start? Where is that cash flowing?
First and foremost, food.
Food, really. I would have guessed AI or drones or something high-tech.
You'd think so, but you can't fight a Cold War on an empty stomach. A huge chunk of that funding is flowing to soybean farmers in the Northeast grain belt.
Okay, that makes sense. Soybeans have always been a leverage point in trade wars.
Yeah. Exactly. The U.S. used to supply a massive percentage of China's soy. That is a strategic vulnerability. There's a quote in the article from Zhao Chengxin. He's the deputy director of their National Development and Reform Commission.
What did he say?
He said, "The Chinese people's rice bowl is firmly held in their own hands."
The rice bowl is firmly held in their own hands. That's a very deliberate choice of words.
It is. It signals a shift toward total food autonomy. They do not want to rely on American farms to feed their population anymore. If the U.S. decides to cut off food exports, China wants to be able to say, fine, we have our own. It's about taking that weapon off the table.
So food is the foundation of this fortress. What else are they reinforcing?
Energy. Significant investment in renewable energy infrastructure.
Which, again, we usually talk about that for climate reasons.
Right, and that's part of it. But in this context, it's about security. It's about reducing dependence on foreign oil and gas supply chains that could be blockaded or sanctioned. If you can power your factories with wind and solar made at home, you're less vulnerable.
That makes total sense. Security over efficiency. And surely technology has to be in there somewhere.
Well, it's center stage.
Yeah.
The article mentions the Grand Fund.
The Grand Fund. Sounds like a heist movie.
It kind of does. It's the nickname for their massive state-backed investment vehicle for semiconductors. In May 2024, they launched the third phase of this fund.
And how big are we talking for this third phase?
$47.5 billion.
$47.5 billion.
Just for chips.
Just for this one fund. And to give you some perspective, that is larger than the first two phases combined.
So they're not just doubling down.
They are quadrupling down. They are pouring money into domestic semiconductor manufacturers to break free from Western technology. They know that if the US and Europe cut off access to advanced chips, which they started to do, China's tech sector freezes.
So they're trying to build the whole thing from scratch, inside their own borders.
Exactly, and it really feels like they're battening down the hatches.
Like they're expecting something bad to happen. That is exactly how they are describing it internally. The source notes that Chinese officials are describing the situation as preparing for dangerous storms stemming from continued U.S. pressure.
Dangerous storms, that is ominous.
It's a recognition that this isn't a temporary trade dispute. They view this as a long-term existential struggle.
Okay, so that's the view from Beijing. Fortress China.
Oh.
$1 trillion to become bulletproof. But let's flip the lens. What is happening on the American side? Because we aren't a centrally planned economy. The president can't just tell every company what to do.
No, but the market is reacting just as dramatically. We are seeing a massive corporate exodus. And it's not just about government mandates, it's about survival.
Right. The article mentions a specific example that I think really grounds this, a company called Husco.
Yes, Husco, a hydraulic systems manufacturer based in Waukesha, Wisconsin.
Sounds about as American manufacturing as you can get.
It does. And for years, like many companies, they relied on China. But the CEO, Austin Ramirez, he saw the writing on the wall. He cut imports from China by about 80%.
80%. That's a huge logistical undertaking.
Huge. They moved those supply chains back to the U.S. and to other friendly nations. But what's fascinating is why he did it.
Yeah, was it just tariffs?
It wasn't just tariffs. Ramirez noted that he was facing pressure from his customers.
Really? So the customers are driving this?
Exactly. They were demanding minimal Chinese content in their products because of all the uncertainty. They didn't want to be holding a product that suddenly becomes 3 times as expensive because of a new policy.
So it's risk mitigation. It's not just made in America. Patriotism is, I need to know my parts will actually arrive.
Precisely. We are shifting from just-in-time efficiency to just-in-case security. And it's not just mid-sized companies like Husco. Look at the tech giants.
The article drops a bomb about HP.
Yeah. Hewlett-Packard.
By the end of 2025, HP reported that more than 90% of its products sold in North America would be manufactured outside of China.
Think about that for a second. For 2 decades, laptop and made in China were practically synonymous.
The whole ecosystem is there.
The entire thing. For HP to move 90% of its North American production out, that is a tectonic shift.
Where are they going? Vietnam, Mexico.
Vietnam, Thailand, Mexico, some back to the U.S. But the point is, they are leaving China, and they are doing it fast.
It really underscores that this isn't just political bluster. You don't move a factory unless you think the relationship is permanently broken.
Right. You don't do that for a 4-year presidential term. You do it for a 20-year strategic shift.
Yeah.
U.S. manufacturers are betting that the divorce is final.
But wait a minute, I have to play devil's advocate here. Because I remember seeing headlines recently about a deal, a truce.
You were thinking of the November 2025 agreement.
Yes. The truce, didn't that fix things? Didn't they shake hands and lower the tariffs?
Fix is a very strong word. Let's look at the details. Yes, there was an
It
agreement.
sounded big.
On paper, it looks significant. It lowered U.S. tariffs on Chinese goods from a staggering 145% down to a combined rate of about 30%.
That is a huge drop. 145 to 30, that sounds like making up.
And China reciprocated. They reduced tariffs on U.S. imports to 10%.
Okay, so tariffs are down. That sounds like peace.
It sounds like it, but look at the context. Even with those reductions, the tariffs are still there. 30% is still a massive barrier.
True.
But more importantly, the trajectory hasn't changed. Analysts call this accepting the divorce and negotiating the terms.
Ah. So we aren't getting back together. We are just deciding who pays for the movers.
Exactly. It prevents a total collapse, but it doesn't change the direction. TD Bank put out a projection that is quite sobering.
What's their take?
They project that bilateral trade will fall to less than half of pre-2017 levels, regardless of this truce.
So even with the handshake, the volume of trade is still going to be half of what it was.
Because the trust is gone. You can lower a tariff tomorrow, but you can't convince HP to move their factory back from Vietnam. The structural changes are already locked in.
It comes back to that idea of security over economics.
There is a quote from economist Ed Yardeni that really nails this. He told CNN, "It's not pleasant to witness. He's trying to leverage America's economic strength to intimidate other nations. But it will be very difficult to intimidate China."
That's the crux of it, isn't it?
It really is. You have two superpowers, and one is using its market to pressure the other, and the other is spending $1 trillion so it can't be pressured.
And that just creates a feedback loop of separation.
A spiral. And it seems like we are past the point of no return.
So let's recap what we've laid out here, because when you stack it all up, it is staggering.
It is.
We have trade volumes at a 24-year low, essentially erasing the entire WTO era. We have China spending a literal $1 trillion to build a self-sufficient fortress for its food, its energy, and its chips.
Preparing for those dangerous storms.
And we have major U.S. players, from heavy industry like Husco to tech giants like HP packing up and leaving.
All happening in the span of just a few years.
So what does this mean for the person listening to this right now? Why should they care if HP makes laptops in Thailand or Shenzhen?
Because the world you live in is being redesigned. For the last 20 years, we enjoyed a period of deflationary growth. Things got cheaper because we outsourced everything to China.
Cheap TVs, cheap phones, cheap clothes. We all took it for granted.
Right. That era is ending. When you move supply chains for security reasons, costs go up. Resilience is expensive.
So that's the price tag of the divorce you mentioned earlier.
Exactly. For you, the listener, this means potentially higher prices for goods as the new baseline. But it also means stability.
How so?
Well, if there is a geopolitical crisis, maybe your car production doesn't halt because the chips are being made in Ohio or Germany instead of being stuck on a boat from China.
So we are trading cheapness for safety.
In a way, yes, but it also affects the global food supply. This uncoupling sends ripples through everything.
It really is the end of an era. We're watching the global economy fragment into blocks right in front of our eyes.
We are. And that raises the biggest question of all for the future.
Which is?
If the U.S. and China successfully build these fortresses, if they both achieve relative independence in food, energy, and tech press, what happens to everyone else?
That's a great question.
Think about it. If you're Brazil or Germany or South Korea, for years you could play both sides.
Sure.
You could sell to China and buy from the U.S. But if these two systems are completely decoupling technologically, financially, you have to choose.
Are we entering an era where neutrality is no longer an economic option?
That is the worry. If the iPhone and the Huawei phone run on completely different internets with different supply chains using different payment systems, you can't really exist in the middle anymore. You have to pick a socket to plug into.
A frightening thought. We might be moving from a World Wide Web to a worldwide wall.
A fractured world.
Yeah.
And we are just seeing the foundation being poured.
Well, on that cheerful note, I think that's a perfect place to leave it for today. This is a lot to digest, but understanding that this isn't just trade war noise is crucial. This is the new architecture of our world.
Absolutely. It's the story of the next decade.
Thanks for diving in with us. As always, check the show notes for the full sources.
If you really like spreadsheets,
We'll see you on the next deep dive. Stay curious.
take care.